Jamie Dimon's evolving stance on crypto and blockchain reflects a significant shift in the mindset of traditional financial leadership. For many years, the JP Morgan CEO was one of the most vocal skeptics of cryptocurrencies, frequently criticizing Bitcoin and warning about regulatory risks, fraud, and speculative excess. His earlier comments framed crypto as a temporary phenomenon with limited real-world value. However, in his more recent public statements and interviews, Dimon has acknowledged that crypto and blockchain technology are real and increasingly inevitable as part of the global financial system's evolution. While he continues to express reservations about certain aspects of the crypto market, such as volatility and misuse, his tone has become notably more pragmatic. He now recognizes that distributed ledger technology has practical applications in payments, settlement, and financial infrastructure, and that customer demand for digital assets cannot be ignored. This shift is also reflected in JP Morgan's actions. The bank has expanded its blockchain initiatives, developed its own digital payment and settlement solutions, and explored tokenized assets and on-chain transactions for institutional clients. These moves demonstrate a transition from ideological opposition to strategic engagement, signaling that even the most established financial institutions are adapting to the rise of digital finance. Dimon's change in perspective underscores a broader trend across traditional finance. Skepticism is giving way to cautious acceptance and structured adoption. As regulatory clarity improves and real-world use cases mature, leaders who once dismissed crypto are now acknowledging its permanence within the financial ecosystem. Educationally, this evolution highlights how blockchain is moving from a disruptive experiment to a foundational technology that major banks must integrate rather than resist. In essence, Jamie Dimon's journey, from outspoken critic to reluctant recognizer of crypto's legitimacy, mirrors the transformation of the global banking sector itself, as it confronts the reality that digital assets and blockchain-based systems are becoming an integral part of modern finance. XRP is the native digital asset of the XRP ledger and was specifically designed to facilitate fast, low-cost, and efficient international payments. Unlike traditional systems that depend on multiple intermediaries and slow reconciliation processes, XRP functions as a bridge currency that allows instant value transfer between different fiat currencies. In contrast, legacy networks such as SWIFT primarily provide messaging services between banks rather than real-time settlement. A typical SWIFT-based international transfer can take 1 to 5 business days to complete, involve several correspondent banks, and incur high transaction fees. Additionally, funds are often locked in pre-funded Nostro-Vostro accounts, creating capital inefficiencies and increasing operational risk. XRP-powered solutions developed by Ripple eliminate many of these bottlenecks by enabling on-demand liquidity. Instead of holding large reserves of foreign currencies, financial institutions can convert their local currency into XRP, transmit it across borders in seconds, and then convert it into the destination currency. This process reduces settlement time to 3 to 5 seconds and cuts transaction costs to near zero, regardless of geographic distance. Beyond speed and cost, XRP also enhances transparency and reliability. Transactions on the XRP ledger are recorded on a public immutable blockchain, allowing real-time tracking and reducing disputes between counterparties. This is especially valuable for high-volume sectors such as remittances, trade finance, and potentially commodities like oil and energy, where payment delays can disrupt supply chains. Educationally, XRP should be understood not merely as a speculative crypto asset, but as a piece of financial infrastructure designed to solve concrete problems in global payments. By addressing inefficiencies inherent in traditional systems like SWIFT, XRP represents a shift toward real-time, borderless settlement, positioning it as a practical tool in the transition from legacy banking networks to blockchain-based financial rails. One of the most prominent examples is JPM Coin, the bank's blockchain-based digital currency designed to facilitate instant transfers of value between institutional clients. JPM Coin operates on JP Morgan's private blockchain network and is primarily used for wholesale payments, treasury services, and cross-border settlements among corporate and institutional participants. Through this initiative, JP Morgan has shown that blockchain technology can significantly improve efficiency compared to legacy banking systems. Transactions that once took hours or days through correspondent banking networks can now be completed in near real time, with greater transparency and reduced operational risk. The bank has also expanded into tokenized deposits, on-chain settlement of securities, and digital asset custody, signaling a long-term strategic commitment to blockchain-based finance rather than short-term experimentation. These developments closely parallel the utility-driven model behind XRP and the technology developed by Ripple. While JPM Coin functions within a closed, permissioned network controlled by a single institution, XRP operates on a public, decentralized ledger and serves as a neutral bridge asset between different currencies and financial systems. Both approaches aim to solve the same core problem: making cross-border payments faster, cheaper, and more efficient than traditional systems such as SWIFT. The comparison highlights an important convergence in global finance. On one side, major banks like JP Morgan are building proprietary blockchain solutions for internal and institutional use. On the other, Ripple and XRP are offering open, interoperable networks that connect multiple banks, payment providers, and markets worldwide. Despite structural differences, the underlying objective is shared: real-time settlement, reduced reliance on intermediaries, and improved liquidity management. Educationally, JP Morgan's blockchain initiatives validate the broader concept that digital assets and distributed ledger technology have practical financial value beyond speculation. The fact that one of the world's largest banks is deploying its own digital coin underscores that the utility XRP was originally designed for, instant, low-cost global payments, is now being pursued across both traditional finance and crypto-native platforms. In this sense, JP Morgan's crypto involvement and Ripple's XRP strategy reflect two sides of the same transformation: the modernization of global payments infrastructure through blockchain technology. As these systems mature and regulatory clarity improves, the lines between traditional banking and crypto-based finance are increasingly blurring, accelerating adoption and reshaping how value moves across borders. Clear and comprehensive regulations, such as initiatives like the Clarity Act, are essential to create a fair and predictable environment that levels the playing field between traditional banks and crypto-based financial platforms. Without well-defined rules, companies face uncertainty around compliance, asset classification, custody requirements, and permissible business activities, which discourages long-term investment and slows technological development. When regulatory frameworks are unclear or inconsistent, innovation tends to migrate to countries that provide more structured and supportive policies. Regions such as Europe, the Middle East, and parts of Asia have already implemented defined digital asset regulations, offering guidance on stablecoins, tokenized assets, and blockchain-based payments. In contrast, prolonged ambiguity in the U.S. risks driving entrepreneurs, developers, and capital overseas, reducing domestic leadership in financial technology and weakening competitiveness in the global economy. Clear regulation also prevents unfair competition between banks and crypto firms. Traditional financial institutions operate under strict regulatory standards, while crypto companies have often been subject to fragmented or enforcement-driven oversight. A unified framework ensures that both sectors can innovate responsibly under the same legal expectations, encouraging collaboration rather than conflict. This alignment allows blockchain solutions to integrate more smoothly into existing financial infrastructure instead of remaining on the fringes of the system. Furthermore, regulatory clarity builds trust among institutional players. Banks, asset managers, and multinational corporations are far more likely to adopt blockchain technology when legal risks are minimized and compliance obligations are transparent. This unlocks institutional capital, accelerates adoption of digital payment systems, and supports real-world applications such as cross-border settlements, stablecoin issuance, and tokenized financial instruments. Educationally, this highlights an important principle. Regulation is not an obstacle to innovation, but a foundation for sustainable growth. Well-crafted laws like the Clarity Act can protect consumers, preserve financial stability, and at the same time foster technological advancement. By establishing clear rules domestically, governments can prevent innovation from moving overseas and ensure that the next generation of financial infrastructure is built within a secure, competitive, and forward-looking regulatory environment. As the global crypto market continues to expand beyond speculative trading, attention is shifting toward assets that demonstrate clear utility, regulatory alignment, and scalability. XRP stands out in this environment because it was designed specifically for high-volume payment flows and cross-border value transfer rather than solely as a store of value. Institutional adoption represents one of the largest growth opportunities for XRP. With improving regulatory clarity and the integration of blockchain infrastructure into traditional finance, banks, asset managers, and payment providers are actively exploring digital assets for settlement, liquidity management, and custody solutions. The potential introduction of XRP-based exchange-traded funds, ETFs, further strengthens this trajectory by providing regulated and accessible exposure for institutional and retail investors alike. ETFs can unlock significant capital inflows while reinforcing XRP's legitimacy as an investable and functional asset within regulated markets. Beyond financial markets, XRP's strongest long-term driver is its real-world use case in global payments and remittances. Through technology developed by Ripple and powered by the XRP ledger, XRP enables near-instant cross-border transactions at minimal cost. This is particularly valuable in remittance corridors connecting emerging markets, where traditional banking systems are slow, expensive, and often inaccessible to large segments of the population. By reducing fees and settlement times from days to seconds, XRP improves financial inclusion while increasing efficiency for payment providers and end users. As adoption grows across institutional finance, regulated investment products, and real-world payment networks, XRP's market potential becomes increasingly tied to utility rather than speculation. This shift reflects a broader transformation within the crypto industry, from experimental assets to functional financial infrastructure. If regulatory frameworks continue to mature and institutional confidence strengthens, XRP is positioned to benefit from a convergence of factors: expanding crypto markets, growing ETF participation, and rising demand for faster, cheaper, and more reliable global payment solutions. Ultimately, market growth combined with institutional integration and practical use cases, such as remittances, positions XRP as a bridge between traditional finance and blockchain innovation. Its success will depend not only on price movements, but on how effectively it becomes embedded in everyday financial operations across borders and industries.